Welcome to the Aramir Roundtable. Today is the 18th of January, 2019. We have our guests, Charles Cottle and Ali Pashaei. So welcome, gentlemen. Nice to have you here.
Good to be here.
Thank you. Thank you for your patience, everybody. Let's get this show on the road. You already did the disclaimer stuff? So
not yet.
Oh, you haven't?
No.
You want to do it?
Just real quick, that Aramir is not a broker-dealer investment advisor. This is for educational purposes only. Options and futures do involve risk and are not suitable for all investors. And that's basically, if you want to read the whole thing, pause the video or go to the bottom of any of our web pages. And you can add to that if you like to, of course. And Charles, I'll just put myself on mute just in case there's any background noises. I don't want to interrupt, but I'll be here for the whole time.
All right, feel free to interrupt me, Ali, if there's any questions. My portion of it is today is I thought that I would give a little explanation about what we've been doing for the last few months and some of the more interesting things that I've touched on here was hedging a portfolio of stocks. So we know most of us are options traders, but a lot of options strategies, options only strategies, which I call OOS, O-O-S, options only strategies, are suitable, conducive, and recommended for people who are hedging. And the hedging community traditionally has only had a few different strategies that they could do, namely the covered right, which is selling call options against long stock. And that is impersonating a short put. The other one is to buy a protective put, but that gets very expensive. But when you do that against the underlying, the position will behave like a long call. And by the way, both of these didn't do too well in February or in the latest move, October, down, and probably with the market doing what it's doing, you might want to consider maybe lifting those hedges or modifying it. But when you have a consciousness of what I call Oz, Oohs and Ahs, it's not like AHA Oz, but AHS, which is alternative hedging strategies. It's going in the direction of the third one that I didn't mention yet, which is the fence or the collar, which is to sell a call out of the money and buy a put out of the money. And that behaves like a bull spread. And not many people know that if you sell the in-the-money call instead of the out-of-the-money call and buy an in-the-money put instead of an out-of-the-money put, that position will behave like a bear spread. So we call that a bear collar. Well, there's more. Why not have it behave like a butterfly? Why not have it behave like a broken wing condor? Why not have it behave like a calendar spread? And you can do that if you choose different strikes to do against your stock, and then the position will behave that way. And so that's kind of what I'm presenting today with a little bit of examples from the last few months. So this is Dialing the Land of Oz. Some of you know my options metamorphosis from my book that members can get free, and anybody can get it free if they sign up at my website, riskdoctor.com. It'll email you the PDF. But these pictures are, at the top, you got skip strike flies, and here you have slingshot variations, whether it's a butterfly that's in blue or the condor slingshots that are in red. And then you got broken wing condors and butterflies. I mean, the condor variations are in red and the butterfly variations are in blue, and these are broken wing these are slingshot variations also, where it dips below the line. The top ones don't dip below the line. Then you got broken wing condors and broken wing butterflies, and then you have some power plays like a W situation, or where you can make money in either way and be short premium at the money. So there's different, you can hedge into these with your stock. So we had a portfolio that I'm going to be talking about that consisted of bullish candidates, which we started on September 18th. And the bullish candidates were Apple, Microsoft, NVIDIA, and the Qs. And what's a bullish stock? Well, that's one that's just a stock that has stacked moving averages all aiming north with shorter time frame above the next. So if you have many different, most people use at least the 200 and the 50, so the 50 would be higher than the 200. But if you're also using like the 34, the 21, these are Fibonacci numbers, and the 8, some of you are familiar with that, that the 34 would be higher than the 50, the 21 would be higher than the 34, and the 8 would be higher than the 21, and everything's aiming north. And these top in the green qualified for that description. The next ones were mild correction hedge candidates, and that was Google and JP Morgan. If the stock is between the 50 and 200 moving averages, then and other moving averages are crossed and not stacked in order, that would indicate that it's in a mild correction. Fully corrected would be Facebook and Netflix in this gray. If the stock is at least 10% below the high and the moving averages are crossed, not stacked in order, they would be qualified for that. And you'll notice that I have Microsoft in its different colors, and all these down here are different colors because over the period of time from September 18th through the end of the year, these guys have switched their allegiance, if you will. Netflix was neutral when we started, or rather it was in corrective hedge, but then it was bullish, and then it was mild correction, and then it was bearish, etc. All these. We noticed that Win was, which is down here, which is a bearish candidate with BABA in the red. The stock is below all, and the stacked moving averages are aiming south. So the 8 is lower than the 21 and lower than the 34, and the 34 is lower than the 50, and the 50 is lower than the 200. So, and we also use Diamonetrics, which is a proprietary technical analysis where I have these likely expiration ranges where uptrends merge with downtrends, and use that as well and combined all of them. So sometimes you might have a bearish candidate, it's at the lower end of its range. And so we manage the trades and adjustments in the forum, and all trades as Oz could otherwise be done as oohs. And sometimes after a while, I got everybody understanding when you have the stock and you do a put as a hedge, that turns it into a call. And then I worked with that call as a component of the overall butterfly or broken wing or whatever it was going to be. And it was bullish or bearish, depending on not only these green, yellow, gray, and red as defined, but also the Diamonetrics. So let's go into it. Here was the performance because, and this is important with the concept of, well, what do you do with the earnings? Because as the stocks are losing, and they all did, all the stocks lost, we started hedging the portfolio. We started talking about it on the 18th. We did a couple of hedges on the 18th. So the first hedge date in column F was for Apple and Facebook. We did right on that day, but we waited a couple of days for BABA on the 20th. We didn't hedge Microsoft until the 1st of October, and also Netflix and Win, and the Qs on the 2nd, and then the remaining 3 we did on October 3rd. So you could see that we really avoided the debacle that happened in the stock market. This was the portfolio on the day, 1.3 million. It had 1,000 shares of Apple, and all these amounts. And these were the portfolio values. And then we locked in the hedges on these dates with the stocks trading at these prices was the day that we hedged them. So Apple, for example, let's look at Google. Google was, on the day we started to, it was 1167, but we held out and hedged this when it was at 1210 on October 3rd. So we got lucky with that. So the locked-in values are more than the portfolio starting values as at the close in the day we did this initial presentation. So then, but by 12/31, had we done nothing, the portfolio was worth $1 million, and 95,000 right here in column I. And so this is how much we saved. We saved 334,000. Well, that means our options, whether they were combos, which is a synthetic short stock, or butterfly or something, it stopped the bleeding and turned it into the amount of risk that we put on the table, which I'm going to give you two examples. One where we were a loser on these hedges, meaning the Oz hedges, what we were playing for, but the fact that we were hedged saved and in effect made all this cash that then we have to consider reinvesting if we want. So here was the performance of the actual options only strategies. If you would have done options only, it lost 38.80, meaning the above and beyond saving all this 334,000, our speculative plays actually lost 0.28%, this $3,880. So this 24% savings actually netted out at 23.71, or this 329,000 over here in column M. Now, here's the commissions in column L, because there were a lot of trades in each one of them, some more than others. Some had more adjustments. Some we just, went to flat with a combo when the position came to expiration. And if you were playing these one at a time, and in the future, when we move forward, I'm not going to manage this portfolio anymore because the expiration date is today on everything. So there's nothing left. But if you were just playing one at a time, then Apple making $55,000, we would have 350 shares more that we can buy. Now, this does not take in consideration taxes. So let's take in consideration taxes, and let's think of it more as a balanced portfolio instead of these individual amounts of stock that we can buy with the savings of each individual one. So if you take out the tax, and I'm going to assume the highest tax bracket of 35%, that would be 115,000 in taxes. So when you take out that 115,000 in taxes off of this gain, you have 214,000 left to invest. Now, when you add that to the total of what's the portfolio value at the end here, so I'm carrying on to the lower half of this spreadsheet, where we have the closing prices and the closing values. What if we wanted to make them all equal? So there's 10 stocks, 10% allocated to each. That would mean that we need 830 shares, 955, 999, 1289, etc. However, we want to be able to hedge with options, so we want even numbers. So I rounded it to the nearest 100 in column G, starting in row 19 and going down, 800, 1,000, 1,000, 1,300, etc. So that means that the 1,000 that we have in Apple, we have 200 already too much, so we have to sell those. And we have to sell some Qs and sell some Google. And when we do that, and we didn't consider a tax on that because we don't really know your individual tax basis. We don't know when you bought it. You could have bought Google higher than 1,200. We don't know. We don't have, well, we had the portfolio here. So we don't know where you paid for most of these. So Google, it's pretty obvious that's a gain that we have, but we don't know how much, so we don't know how much tax, but that's taxed at a much lower rate, but that's the only thing I ignored there. So when you rebalance the portfolio, it would be 1.277 of this 1.309. That means that we have kept some of our powder dry. We have 32,500 for some options trading. Okay, so that's pretty much the logic behind what we did. But again, in future, you give me a stock that you like, send me an email tomorrow. I'll start running Diamonetrics and doing my Fibonacci retracements and my moving average crossovers and my work that I do to share those opinions and why I want to select the strikes I'm doing because of support and resistance. And that's the way we'll move forward. And hopefully a lot of people want to examine a lot of stocks. And sometimes you're going to send me a stock that has just absolutely no options liquidity. And I would normally say, forget about it. But if you really have that stock and you're stuck because you work for that company and you have liquidity issues, then I'll deal with it. But if it's something that's just a name that you don't necessarily have any real axe to grind and where you need to trade it, then I'm probably going to suggest that we ignore that and move on to something that's more liquid. So, so the first hedge that we had was bullish. We know Microsoft was bullish. And so we turned that not necessarily into a bullish play the first time. We just said sideways on it for various reasons. I don't think I do have the chart. Here's the chart. It's behind, you can sort of see through. I'm going to go through all these. We're going to follow this dashed line, and we're going to go through the green, then to the white, then to the orange, then to the blue, and to the pink and the green. So we're going to follow the order of these trades, which are identified by these dots of where we made the hedges, but we'll get there in a couple of minutes. In the meantime, let's go back here. So I want to focus on showing you why the synthetic, this Oz is equal to the ooze. So the ooze would be this butterfly going for 39 cents. So we know that 500 shares of $100 stock is over $50,000 on the table. But when you do this hedge where you're long 500 shares, you buy a protective put, and then you sell 2 calls at the middle strike and buy 5 calls at the higher strike. So the 2 here, right here, the 505, that's a synthetic call at the 113 strike. So this 113, 115, 117 configuration, the way I have it, and I have it as orders as, the 10 and broken up into, you could do the 5 combos in one trade and then 5 verticals in another trade. And we saw that it could be commission intensive, but we saw that the commissions were like 0.08% of our overall P&L. So it was an insignificant number when you look at it, what you're trying to protect, a $1.4 million portfolio. So we can't nickel and dime to try and save commissions. And I assume the buck a contract per commission. Not everybody pays that much. A lot of people have 0 commissions when especially if they have a $1.4 million portfolio, or some people are paying 50 cents a contract, or 65 cents a contract, whatever it is. I just used a dollar to keep it simple. So, but we see I have the check marks in Thinkorswim on the stock and these the put and these calls, and look at what it looks like. It looks like a butterfly. Notice I unchecked this butterfly up here, which is going for 39 cents. 5 times 39 cents is $200, right? Under $200. So we go from over $50,000 in risk to under $200. So that's the power of this hedge. Now, unlike a covered right, you have unlimited downside risk, and Microsoft didn't do too bad. It didn't get beat up like a lot of the other stocks. But the bull collar wouldn't have worked. The married put wouldn't have worked, where you turned it into a call. But this, though it lost a lot less, and stood to make quite a bit. It could have made 4 times that. We look to double or triple on a butterfly. We don't really play it into expiration where it will go to the full $2, but that's an options only explanation that can come later if you don't already know it. But notice that the most we could lose here is $140. That implies that each one of them is 35 cents. So it's a little bit off. So there's these locks are all open. So it's just the averages, the marks of the bids and asks. So it's really close, but you get the idea that this Oz hedge synthetically is the same as the ooze trade. Okay, make that point. And I show it in this dissector, which our members also got my position dissection course free. We originally used to sell for $350. It's free to the members who joined up, and that's available for them to download. And it's just repeating this position. So here's the 5 underlying, 500 shares. It's noted as a 5 lot of underlying. It's the October series. We have calls on the left, puts on the right in this first half of the section. Over here, we do our dissecting, and over here in columns T, V, and X, we have what's left over. So here's the positions. We were currently had 5, and I showed it in the current column and the adjustment column. It could have been done as a 10 lot all here and a 5 lot here, but I separated just to show you the different orders. And synthetically, it's an iron condor. But if I will learn later that if I change what I call the pivot strike, if I make it higher, we'll look at it all as put butterflies. And if I put it lower, to look at it all as call butterflies. It's all synthetically the same thing, just taking out a different amount of boxes. And I better hurry up because Ali wants to get in here. We started a little late. Somebody send me a text message to see what time I should stop. And then we go and we dissect it. I won't go into dissection, but it dissects out to these baby butterflies, 5, 10, and 5, or a condor here, that when you ever have 3 in a row like that, that means it's a condor, 3 baby butterflies sets in a row, and another butterfly there. And then this is from my book showing you that one big butterfly at the bottom here, a 2 strike from wing to body, is synthetically these 4 babies with 1 strike to wing and body. And here's mathematically how that falls out. Some of you who know me have, understand this already, but they add up money-wise and they add up contract-wise. So if you list these butterflies going across, you see that, for example, the 90s strike has short 2, long 1 cancels out to 0. So that's why it's synthetically the same. All right. Somebody's texting me on my phone. I haven't looked at that. I want to see what time we go till. 3 or 4 minutes left. Okay, so let me quickly go through. So Tom has emailed you this. Here was the values of this. We were long 500. We turned it into a butterfly. We adjusted it into a bear spread when the call spread that we were short was too cheap to be short, and we were kind of bullish down here at this point where it met this line here, my half channel, and then eventually at October 19th, it was all worthless, and we had a 290 loss, and later we hedged it into a bigger butterfly, the 100, 105, 110, when we were at this pink point, thinking that it would be at a 105 by expiration, and then that ripped up too because it was worthless, but we were in that one for 91 cents. And then here was a close-up that's a little blurry. And it has the summary of Microsoft there with the commissions. And then we went through here. Here we bought a double butterfly in A. So I'm going to show you what that looks like when you have a butterfly in October and a butterfly in November. That's an interesting strategy. So here's the butterfly in October. Here's the butterfly in November. When you have them both at the same, it sort of looks like this. And we eventually turned that into a bear spread. And then we also turned it into a dub bear spread, which is we sold calls against it. And it looks sort of like this one down here. So just to speed up through here, here's the summary of that. We made it quite a lot of money in that one. And I just want to say one more thing. There's the dissections of it. We don't have time for it. And here's what it looked like at the time. When we one iteration of it, where it sort of looked like a straddle with an extra short bear spread. So that was kind of interesting, and it would talk about it in the forums. Here was the bear spread there. And then at the end, the very end, I'll wrap this up in the next minute, the last day of expiration we had on both of these, so we had Microsoft against BABA. BABA was bearish, Microsoft was bullish. The value on the table at the time was our butterfly that we had for 91 cents. Effective debit was $1.96. I was riding that because we were only trading at 101.51. So we thought that if it could move up, I could make a little bit more. If it was my only position, I probably would have taken it off. But against it, I had BABA, which was going for 5.15, our put debit spread, and our call credit spread, which we had closed. So we sold this for $3.95. We covered it at 24 cents, too cheap to be short. We were still riding what was effectively costing $3.54 for 5.18. And then by the end of the day, we were able to get $9.12 for our BABA, and our Microsoft went out worthless. Here's a summary of it. And, from the beginning of the day to the end of the day, we made an extra $1,000 by, having sort of like a pairs straddle a pairs trade of sorts. That's it. That's all I got. I'll just let you know, Capital Discussion members, or the members here, get $200 off of hundreds of videos and thousands of pages of PDFs of forums. So I'll relinquish my time to the speaker. Next speaker.
Sounds good, Charles. I guess just stop your sharing and then Ali can take over.
Okay, stop share.
And Ali, you're up.
All right. Guys, can you guys hear me?
I can.
All right. Push the share button here. And Tom, do you mind jumping in if there's any questions that might come up?
Yeah, sure.
It.
Yep.
Thanks. All right. So let's see here. Okay.
All right, we see your screen.
Okay. Is it the maximize screen?
Yep, it is.
Okay. All right. Well, thanks everyone for being here. It's good to be here. Let me go through the disclaimer real quick. The theme is going to be how to survive and thrive in volatile markets. The disclaimer, we went over that real quick. Just want to say that everything here is for educational purposes. If you hear me say something, I'm just stating my opinion. I'm not recommending anything to anyone. I do have some ideas and solutions on how I would deal with a crazy volatile or unpredictable market, but those are just my solutions, and I'm not necessarily suggesting anyone should do those. So with that said, here's a real quick agenda. I'm going to do a quick overview in terms of a background, talk about the current market, what's going on with it, what I see as the challenges, what I think are my solutions, and then go over some of the trades we've been doing, and then wrap that up with a conclusion and Q&A. Charles went first. This is a quick background about Charles. He's one of the co-founders of Thinkorswim. He's a market maker, floor trader for SIBO back in the 80s, and he's someone I consider one of my mentors, and I'm currently working with him. We're both doing a mentoring program through Aramir. That's a little bit background about me. I've been using and trading options, investing with them and trading since 2001. I'm working with Charles currently in a mentoring program. I trade my own account and manage family money, and I do consulting and private one-on-one mentoring as well. I do have an online private Google group. In case you're interested, it's free to join. You just need to send me an email. So with that out of the way, let's talk about the market. So what I'm seeing with this market is I believe certain things are fundamentally changing. I know there are talks regarding trade wars and geopolitical stuff, and whether we have earnings growth or not. I'm not too concerned about those. These kind of events come and go. The Fed is going to be an issue, in my opinion. The QT, which is reversing the QE, is probably one of the issues that might be there. Again, depends if the Fed changes direction or not. But one of the really top hedge fund managers that I respect, Ray Dalio, if you haven't heard of him, I strongly encourage people to Google his name. He says that we are in the 7th inning of the current economic cycle. So, his prediction isn't that something's going to happen now or even next few months, but, we're potentially for the next decade or so, we're not going to be in the same type of a environment that we have been in the last 10 years. Let's just put it that way. Personally, I'm just keeping my mind open about the market. I suspect what Ray is saying is going to be very true, but one of the things I've learned a long time is trade what you see, not what you think. So bottom line is volatility, elevated levels of volatility relative to what we've been seeing in the last few years where we had sub 14 VIX. I don't think we're going to see that anytime soon. But then again, who knows, right? So what I would do is essentially be prepared for all sorts of market scenarios going forward. And with that said, the challenge I see with this kind of a market we're in is that we're going to see frequent changes in the market character. And this is something I noted to my group a while ago, that we're going to obviously see large swings potentially, which translates to large swings in our account, which causes stress. But when I say market changes, what I mean by that is we're going to see scenarios where everything looks calm and quiet and everything going back to normal, and all of a sudden we're going to hit a crazy patch. And then as soon as we think all hell's breaking loose, things may calm down again. And one of the results of that is we're going to see levels being violated. But what I mean by that is a lot of people are looking at support resistance, and it's natural to do so, and I do as well. But one of the things I'm expecting is for these levels to be continuously violated. And as a result of that, that's going to trigger a lot of stops for people, or going to potentially create losses. And the other problem, challenges I see is that, you know, some folks don't have a strategy in how to deal with this market, or they can't adapt fast enough. And so when things change up, it frustrates a lot of people. So there's going to be attempts at premium selling when the volatility gets elevated. In my view, that can work, but that can also fail depending on how you do it. And there's going to be attempts at doing market neutral strategies where you're not taking a directional risk, and that could work, but I see frustration with that as well. I get contacted from people who are having a difficulty with either of these in these kind of markets. So what am I seeing as a potential solution, at least from my perspective? When we started hitting the crazy market back in October, this is something I posted to my Google group, and I mentioned to the mentoring classes that we're going through. And I said that one of my favorite strategies to trade during bear market conditions or during volatile markets is wing spreads. Wing spreads, it's just general categorization for butterflies and condors and what I call SSBs, which are skip strike butterflies, and unbalanced skip strike butterflies, and broken wing butterflies, all the variations of, let's call it the butterfly family. So I like these trades. I really like time spreads. That's the second category of trades that I like to do, which are calendar spreads and diagonal spreads. And despite of what a lot of people say that you can't do these or you shouldn't do these when volatility is elevated, I believe that's one of the mistakes or myths. In fact, they could do really well in a volatile market. Some of the folks in the group have been seeing that. We've been trading these calendars and diagonals. And the third category of trades that I like is what I call dynamic hedging. And I'll show you guys some examples of that a little later on, so you know what we're talking about. But the basis for I guess for my solution, step one is to start out with a good trade setup, a good trade structure that could essentially withstand these changes in the market. So that's step one. Obviously, directional trades are fine as long as you have a good system to follow. The second step is to implement a good strategy around that trade configuration or structure. So just a butterfly by itself is not a strategy. It's just a trade configuration. Or vertical isn't a strategy, at least to what I call a strategy. A strategy is when you have a plan around it. You put a plan around how you're going to work with that particular trade structure. So I'm of a strong opinion that we need to simplify things as much as possible, especially during crazy markets, to reduce size. I'm a big fan of scaling in and out, not necessarily putting in a big trade at one time and exiting. When I scale in and out, it's a lot more forgiving in terms of not having to be precise with my entries and exits. I prefer to not take big directional exposure during this type of a market, during uncertainty. I want to reduce leverage, not overuse it. I want to go for higher returns on risk instead of, for instance, putting a big position on, looking to make 5% on it. I rather put a smaller position on and look to make a bigger return on risk on it. And I want to be more context aware, meaning that know where the support is, where the resistance is, what these levels are. and also expect violations of these levels, like what I was mentioning earlier. And just becoming more systematic, having a lack of a plan or idea of what you're going to do becomes more problematic when market is challenging. So you really need to be highly disciplined. And the last thing a lot of times people miss out is the idea of reducing the time in the market. Everybody thinks, not everybody, but a lot of people think they have to always have a position on. They always have to have some skin in the game. There's that, you know, when the market's rallying like it is now, there's a fear of missing out. What I believe is that when there's a high degree of uncertainty, cash is good. It's a lot better not to lose money rather than, you know, try to make a lot of money, for instance. So I would prefer to reduce my exposure to the market in terms of time, and when I see a good opportunity, jump in to take advantage of it. And the third step is to be able to implement steps 1 and 2, right? So, you know, we can say, oh, try to butterfly and follow this plan, but in my opinion, you really need to develop a set of skills around that. And in order to do that, it really means, you know, education, learning more. I'm still learning. I'm still experimenting with things. So I think all of us should continuously to learn. And the biggest thing I see is out there is a lack of specialization. You know, most people are a little bit too, I want to say, distracted by so much information out there, by so many different things you can do, so many strategies, so many products you can trade. I would encourage people to try to specialize, find a few things that you feel comfortable with and get to really know them and focus on them. So, you know, it's a lot better to know a lot of things about a few products or few strategies than to know a hell of a lot about, you know, to know many things but know very little about them. And lastly, just preparation, just being prepared. That's kind of critical. Know ahead of time what you're going to do and almost expect anything out of the market. So let me just share with you some trades that we've been doing so I can, you know, I talked about some of the trade structures and strategies that I think are the solution. So let me give you some examples so you guys know what we're talking about. And these are some of the trades we've done in the last few months. There's a couple of trades here. So this is in the butterfly family of trades. And this is the forum that we're using to post the trade. So in this case, this one was back in done back in November, and we started off with a fairly balanced butterfly trade with very little risk to either direction, up or down. And as the market moved, I basically added new butterflies to it at different strikes. So I added a lower butterfly, which converted it to this. And then the market reversed again, and it added a skip strike butterfly to the upside. And you can see the trades that were done. And then shortly after that, we just removed the trades for a nice profit after a few days. So let me show you what the market looked like during that time. It was right around here where we entered the trade, and the market ended up basically dropping about 5.5% relatively shortly after we entered. And then it pretty much just reversed and headed back to where it was. So when we look at this trade, actually, if we had just done this first trade and done nothing with it, it would have worked beautifully. The market went way down and way up. But, you know, the setup for this trade, or the mechanism for this trade, that the intent of it is to basically keep a balance and not necessarily put yourself in a situation where you lose. And so this is a preference. A lot of times people don't want to take directional risk, and they prefer doing these types of trades. And this demonstrates that. And if I go show you the last screenshot here, you see that this thing had about over a 200-point range that we could cover with the SPX with this trade. And during this trade, we really never took that much heat in terms of being the drawdowns were kept very relatively small. So going back to the slide here, so the key with this trades is delta being delta neutral, or you can be directional about it. We're short premium, which means we're long theta, and the trade is fairly relatively resilient against market moves, and we can keep things fairly balanced. Here's another example. A second trade that we did, we also started with something that was relatively flat to neutral, and then market stabilized a bit, and I added what we call SSB, skip strike butterfly. That's the terminology that Charles uses, to the upside, and that created this type of a double butterfly structure, and we were able to take that off fairly quickly within a couple of days for a nice 25% return. And this particular trade occurred during this time. So as you see, the time in the market was a lot less. We stayed in the market a lot less. We're able to take advantage of this short period of consolidation that took place during this large, crazy mayhem. And I can tell you, so just to highlight something, I'm a big believer in a hit and run approach, especially in a volatile market condition. I'm not a fan of wanting to come in and just because, you know, it's, let's say, certain number of days before expiration to putting on a trade. I want to take advantage of situations where I expect some consolidation to take place, and I want to be able to take my money out quickly before the next big move occurs. So one of the things that I'm paying attention to a lot is these concept of what I call a volatility squeeze and a volatility bulge. A volatility squeeze is where markets calm down for a few days, if you're looking at it from that time frame. And volatility bulge is just the opposite. It's basically at the height of movement, where there's an oscillation that market goes through between squeeze and a bulge, and we want to take advantage of those and not necessarily be in the market all the time. And during this time, the entry obviously wasn't good because we went through a crazy 5% correction and a 5.5% rally. The trade still worked out. In this case, my expectation of the market, both entry and exit, were correct, and hence we were able to stay in the market a lot shorter period of time and get out with a larger profit. The next set of trades I want to show you guys is some calendar and diagonal spreads we've been doing with the SPX. These trades are also can be delta neutral or directional. That's the trader's preference. They're also short premium, meaning you're long theta. They're also very resilient. And in addition, they're also a high reward potential for these trades. So I'm going to show you different variations that we've done. This was an aggressive one-day calendar spread that we did. This was during the height of the crazy volatility condition that we had. This was back in December 20th on a Friday. And but what ended up happening is that the 21st, the market gapped down, and as a result of getting into this specific calendar configuration, the trade hit a home run. Now, one of the adjustments I contemplated was this was a 3-lot calendar, which made about $2 grand, 2.7 thousand in a day. I took 2 of them off. One of the adjustments that I was contemplating to take 2 off and convert one of them to a butterfly which you see this potential adjustment. I didn't do that. I pretty much just took the money on that one. But if we had done this adjustment, the next trading day, which was Monday, we went even further lower, and this would have turned into even a bigger return. So the trade started out as a fairly safe but aggressive trade because it's 1 day to expiration. The next trade that I want to show you, which is also a calendar, I've shown you basically just market neutral trades where we come in without much of a directional bias. Here's where I came in with a couple of pair of diagonals with a bullish bias, and I scaled in. So I did a 2-lot, and the market went lower, and I added another 2-lot to it. And one of the things I was mentioning is that I prefer doing that because I get, again, it doesn't require perfect entry, especially for directional trades. So we came in with this pair of diagonals, which definitely had a bullish bias. And I like these a lot. It's a specific configuration in SPX that we use that gets you a nice bullish trade without much of a cost in terms of theta, at least initially when the trade is entered. So the market actually had an intraday or a 1-day rally, I don't remember, but I was able to then convert the trade, which was up just slightly, to more of a delta neutral trade, pretty much taking out over 90% of the downside risk. So it went from something around $700 of downside risk to only about $100 of downside risk, with a fairly large profit potential to the upside if the market were to continue. Well, unfortunately, the market didn't continue. It went down and sideways. So this calendar basically lost like $90. But if I were to given that chance again, I would do it again because we had such a low risk to a high reward potential that I'm perfectly fine doing these trades. The third trade that I want to show you is basically started out with a slight bullish bias. And you guys can later on slow the video down and look at these a little bit more carefully. We don't have too much time for me to do that. But this started out with a slight bullish bias, and the market did rally a bit. And I was able to then spread it off and adjust it into something that looked like a double diagonal. The market stabilized for just a day or two, and then we were able to take that off for a profit as well. And again, the reason for the exit for this one was the concept of the volatility squeeze. And I prefer that method instead of trying to shoot for a profit target and being adamant about having to get a certain dollar amount. So if I get a reason for a technical exit, I'll take it, not necessarily try to maximize the gains on it based on some pre notion of having to make a certain profit target. And so those are those trades. So this is the dynamic hedging trades. So far everything I've shown you has been short premium, meaning it takes advantage of the market consolidating to make money from time decay potentially or reduction in volatility in case of a butterfly. These trades are actually long premium. So they benefit from market moving in gamma versus sitting still. They can still be set up as a delta neutral or a directional trade. They survive during large down moves and they thrive during up moves. And you could lean them bullish, bearish, or neutral. It's up to you. So let's see here. Here's an example of the IWM trade. It's basically a pair of vertical spreads paired together. It's a bullish vertical that's essentially representative of a long asset. It could be a stock, could be anything else, and it's hedged with a bearish vertical. this is something that we taught in one of the mentoring classes, and it's a deep discussion. It doesn't have to be set up as a pair of verticals. You can configure it differently. This is just one simple configuration that I've been using. So we don't have time to go through the details of how this trade went about, but basically what I'm doing is I'm managing the vertical spreads, the two vertical spreads, by rolling them as the market moves. So here we have the IWM going through a period of time where it's just going up and then down, up and down. So you see this kind of an effect of it swinging up and down, and I'm making adjustments. In one occasion, even selling some call spreads against it. And then eventually what ended up happening is that IWM started really tanking, and then the trade was fine. And then eventually the IWM, we basically took profit on the hedges that we were using on the downside, and the long vertical, call vertical, the bull vertical we had almost went out worthless. So basically just took profit on that one, and we were just left with a bull vertical way out of the money. And I just kept that on for a as a lottery ticket, and the IWM did bounce, and we were able to actually take this out for some profit as well. Was still at a total loss, but recovered some of it. Net, I think this trade, let's see, I think I have it in the slides. Yeah. So the investment was about 5,000 to 6,000 on this one. The drawdown was, I want to say, even less than that, around less than $200, and the return was around 750. And what we experienced after entry was these swings up and down, and an eventual 16% drop in the value of IWM. So we went through a period of going up for about 4.5% and then dropping 16%. So it experienced sideways market. It experienced a big, huge down market, and it pretty much made money. It was pretty stable here, making a little bit of money. It made a good amount of money there. And what was left over made money on this rally too. So net, it was a pretty good trade. The next example, then we started a new one trade, because a lot of people emailed me saying they really like it. They want to see more of it. So we did I did another one in SPY, very similar configuration and similar concept, pair of verticals that we're trading, that were basically managing. And as a result of that, we're still in this trade, and I've kind of kept it on just for educational purposes. And this trade is up real nice money at this point as well. Let's see. So that one, we entered around here, and S&P basically continued to drop, and then it rallied, and here we are now. And this took the investment was around 5 to 8K with this one. The drawdown again had been less than 100, and it's so far it's up about 1,300 with this trade. Now we've had some losers too. We have, for instance, a bullish butterfly in the Qs that's still waiting, because if the market continues to go higher, that could become profitable, but that's down. And in this recent rally in the S&P, I put a bearish butterfly below it. That's also down, but I put it in at a very small amount of risk compared to what I want to do with it. So luckily the loss on those ones are pretty small, and we're perfectly fine with them. We're not panicking out of them because of the smaller position size. So these are the trades that have been working for us.
Ali, on that last
Yes.
slide, Jay Hansen asked how many shares of IWM and SPY were hedged in the examples shown.
Oh, okay. Let's see here. We're doing these with options only. As Charles would say, these are the ooze configurations, so there's no stock involved. With the IWM trade, let's see, we're looking at the SPY trade. I purchased 8 call verticals, 8 bullish call verticals, 15 wide, and I hedged them initially with a 5 verticals, 10 wide in SPY. So it's an 8 lot by a 5 lot in SPY trade. And on the IWM trade, let's see here, that one was a similar size. That was a 5 by 5. So that was a 5 lot by a 5 lot. Okay.
Okay, he
Hope
says
that answers the question. Yeah. Okay, so we can come back and I can answer more questions if you guys have about these trades if we have time at the end. So in conclusion, what I want to say is that, again, reiterating what I was saying earlier, again, this is just my opinion. I think, you know, if everything is going fine, a market slowly rising, and you know, market continuously doing the same thing over and over, week after week, month after month, I'm sure, you know, we could pick a single static strategy and trade it, you know, month after month, and it will just do fine. But that's not how the markets works, right? So we constantly go through changes, and, you know, we're in bull markets, bear markets, low vol, high vol. And I think, again, this is total speculation on my behalf, but I think this pattern of shifting market conditions is going to continue. So based on that, what I think would really work in these kind of markets is to make sure you select the right option structures that make sense, you know, in terms of risk exposure, and make sure you implement the right strategies and approach for them. So like I was saying earlier, you can pick the right trade like a butterfly, but one person trades it differently than another person. You're going to get different results. So the structure by itself isn't enough. You need to have the right strategy around it. And in order to make that happen, we really need to develop the needed skills to be able to do them effectively, meaning understanding pricing structures, you know, and it's not just about getting to know the Greeks and the math behind it. I'm a big believer that we really need to understand option pricing and spread pricing in order to do that. So with that said, let me real quick share with you guys the mentoring program that we're doing. So far, we're on month number 9, and these are the topics that we have so far covered. We talked about vertical spreads earlier on. We switched to getting deeper into butterflies later on. The butterflies and the diagonals you saw were covered in month 4 and are also being traded now and covered in month 9. And the dynamic hedging example that you saw was in month 5. We talked about it then, but I started implementing them and showing examples of it in recent months. And for the past few months, we've also been showing various kind of adjustment and management techniques and dealing with market volatility. So we've kind of been covering that, as well as throughout, we've been covering some of the technical analysis tools and things like that I use, and how I look at the market in terms of my expectations. So with that said, the mentoring program, it's a monthly thing that the normal pricing for it is $125 per month for me, $125 per month for Charles. For people that get a package of Ali plus Charles, you get a bit of a discount. And here's my email information, Charles's email, and Tom's email if you have any questions. And here's we've set up a discount for you guys. I'm just going to click this order page. It's arrowmere.com/AC order. Stands for Ali and Charles order, AC order. And if you go there, we've provided a discount mechanism for you, so you can click this little blue button and see you get anywhere between 15 to up to 30% discount, and this is limited time running until next Friday. These discounts are available, and you can pick whatever months you're interested in, or pick all of them, or pick some of them. And then, once you pick a few up here and there, then you can see that you can go to a continue order, and then you can get a total and go from there. And if you want to learn more about the details of what's going on in each of the months, you can click aramir.com/Ali or /Charles, and that'll take you to a page where you can see some more videos that we've done in the past, free videos, and a more detailed description of each of the months. And here's my page, and you can also go to Charles's page. You see the same thing, that there's some detailed information about each of the months and what was covered. Okay, and so I'll leave this page on, and I'll see if there's any additional questions that
Chuck
I can answer.
How many follow-along trade examples are shown every month?
So so this is not, the program that we're running is not about it's not exactly a trade alert service. And what I do is post trades that are, or try to post trades that are relevant to the topic for the month. And I post the trades that are, that make sense for the current market. So it may be that we don't do, we do few, or there may be a week that we do 2-3 of them. On average, I think on average, at least on my side, Charles has been managing a portfolio, so he's been quite active with his stuff. On my side, I want to say at least one trade a week on average. But they're really there to demonstrate the concepts and teach the concepts that we're teaching in class, to help folks develop the skills. They're really not there as a trade alert service for people to follow, although I know some people are doing it, but that's not the intent for it.
Okay, and that's no more questions. I just on that order page, these are kind of customized. The discount's very complicated, so instead of coding it, I just have you pick what you want, and then it basically sends me a message with what you've selected and how you want to pay. And then I'll either send an invoice, send you a PayPal link, or we can do an ACH transfer. So it's a little not different than the normal order process, but basically you pick what you want and it'll tell me, and then I'll send you a payment information. All right.
The link is right down here. Yeah.
Yep. Okay, well, thanks very much, Ali and Charles. Really appreciate it. Good results, surviving the onslaught the market gave everybody in the last quarter.
Yeah, it's been quite interesting, and I really like it because it helps really demonstrate some of the trades. So so far so good.
Yeah, right. Reality rears its ugly head every now and then.
Certainly does.
That's right.
All right, gentlemen. Well, thanks everyone for coming, and I will get this recording out to everybody, and I'll include the links. So if you want to order, remember that those discounts are good for another week. So if you're thinking about it, it's don't hesitate, because it will go away. And
yep. Until next Friday.
Yep. And with that, we'll see everybody next time. So thanks again, everyone.
Thanks, everybody.
All right. Take care. Bye-bye.